Hey everybody, welcome back to Worried to Wealthy. Today what we're going over is the best possible dividend growth ETF for your portfolio. If you'd like someone else doing the math for you and all this research, go ahead, hit the like button and the follow button, and let's go ahead and get into it. And of course, my disclaimer is, right, keep this as education and entertainment. I'm just a guy on YouTube, not an actual financial advisor. With that being said, let's go ahead and get into it. So what I did on this graph, I put the tickers right here, and I put the S&P 500 just for comparison purposes. And the first thing we look at is 5-year total return, which does include dividends. That's what I did down here, total return, and you can see this graph. Now we get into it, I looked at a couple of different ones, VIG, DGRO, DGRW, Noble, SCHD, and then two that I had no clue even existed, SMDV and LEAD. So far, LEAD is in the lead, no pun intended, but so far so good. Now the next thing we want to look at is dividend CAGR. Now, in order to be a dividend growth ETF, in my opinion, you at least have to have a 7% or more, and so all of these have that. VIG has, I'd say the worst score, I guess, at 7.88, and then as you can see, following it up all the way to LEAD at 26%. And now what a dividend CAGR means is basically the average raise you're going to get from this fund, and it's usually over, the history of the fund. And just a quick note that VIG and SCHD are the only ones that had 10 years worth of data. The rest of them had 6, 7, or 8 years. So I think history is something to keep in mind when doing this, but it's not the only thing. The funny thing is that most people that are retail investors would go, okay, LEAD has 83% total return, so it's beating everybody else, and their raise every single year on average is blowing everyone else out of the water. I'm just going to pick this one and be done with it. And that's why I'm creating this video, because it's not everything. So I'm going to go ahead and show you what I mean. Dividend choppiness is something I think is very, very important, and I think it's overlooked. What you need to do with these funds, you need to go into them and see, for example, we're dividend investors, right? And so we want to invest in quality dividend stocks, and we want those stocks to continuously increase their dividends every single year, right? And so when we want that, we're going to be living off that dividend income. We want that ideally to increase every year, or at least not drastically change. And that's what dividend choppiness is. It's a 5% decrease or more, and 1 would indicate 1 year of that, and 3 would indicate 3. VIG, DGRO, DGRW, SCHD, SMDV have 0 years of dividend choppiness. Remember, 5% decreases or more within the last 10 years. Noble had one in 2020, a decrease of 6% in 2020. I think that's something you can live with, but at the end of the day, it's something I had to mention. But here's the interesting part, is that when you look at LEAD, remember the first two, it's like, wow, this thing must be amazing, right? Well, it's not amazing if you're living off the dividends alone. In 2017, they had a decrease of 13%. They had a decrease in income of 25% in 2020. And just last year alone, they had a decrease of almost half, 42% in 2022. So if you're trying to live off the dividend income, this would be pretty scary to live off of. And that's something that personally I don't like. The next is going to be number of holdings. I'd say a good rule of thumb, you try and get around 200 or more, 200 companies, and that's what I mean. So these three hit the bar pretty well. VIG is over 300, DGRO has over 400, and DGRW is just under 300. And these things go up and down, right? So if someone like when Walt Disney was a top 10 of VIG and they completely eliminated their dividends, well, then we'd have 316 holdings, and they add new companies in when they reach the thresholds. The ones that are a lot lower are these 4 right here: Noble, SCHD, SMDV, and LEAD. 67 holdings and 68, that's just way too little for me. 100, it's still a little bit low for me. The top 10 holdings as a percentage of the total fund, I like to keep this as a rule of thumb under 30%. And so as you can see, most of these are relative, and 35% is not too bad. 40% is getting a little up there. That means the top 10 stocks out of the 104, just 10 of them control 40% of the fund. That's a little too rich for me. So I would say maybe avoid this, or at least know what kind of risk you're getting into there. The fifth and final one really is the expense ratio. Now, what's interesting is that financial advisors usually charge 1 to 2%. So these are all going to be the financial advisor. So if you had $1 million portfolio, right, you would pay anywhere from $10,000 to $20,000, 1% of 1 million or 2% of 1 million. When you look at this, VIG and SCHD are tied for the lowest at 600. You have DGRO a little bit above at 800, and then you have some whopping ones here. And here's where I'm going to black some out and say I'm taking these off my list. I'm taking LEAD off my list for a couple of different reasons. The total return is great. In fact, it's of course number one, and the dividend CAGR is amazing. But when we look under the hood, having 3 years of dividend choppiness and having those choppiness be very big percentages, like I can't imagine losing half of my income in 2022. So I don't like that. The number of holdings isn't anywhere near the rule of thumb we're looking for. The expense ratio, I mean, that's about 7 times more expensive than VIG, yet it doesn't have 7 times the amount of total returns. So for that reason, I'm out. I'm just going to go ahead and black this one out. The next one I'm going to look at and take off the list is SMDV. At absolutely abysmal total returns at 19%. Has good dividend choppiness score and a CAGR, but the number of holdings is kind of low, but really what did me over was the expense ratio. I'm not going to pay, 3 or 4 or 5 times the amount of VIG when the total return is just awful. So we're going to go ahead and black that one out. Okay, and the final one that I'm definitely going to black out is Noble. The 5-year total return is pretty good. The dividend CAGR is definitely in the top third, but it has a dividend choppiness. It's definitely something we can live with, right? By all means, it's not something that's crazy out there. But when there's other ones that have 0 dividend choppiness score and have better diversification, and I'm not paying 5 or 6 times more, right? So I'm going to go ahead and black that one up because, again, it's just a lot more expensive for lower total returns and a little bit of choppiness. And again, it's not super diversified with only 68 holdings. So we're going to go ahead and black that one out. And so what we're left with is VIG, DGRO, DGRW, and SCHD. And if you're looking at this, you're thinking, okay, Worried to Wealthy, we own VIG and DGRO, and they have the lowest 5-year total return and the lowest dividend CAGR. Why would I own these and not these? It's really just a comfortability thing. When we look at a couple different things like VIG and DGRO, the methodology is quite simple. Basically, it's just every company in there basically has to increase their dividends every single year for 10 years or more, and it excludes the top 25% of high-yielding eligible companies from that index because typically when you get very high yield, that typically is a signal something's wrong. The next thing with DGRO is, again, another very straightforward, just a 5-year track record of increasing your dividends and making sure the firm has no more than 75% payout ratio where they're paying more than 75% of their earnings. Now, the reason why I don't pick the higher returners is because it's just not as transparent. The SCHD, for example, they track the Dow Jones US Dividend 100 Index. And basically what that is, if we go into this real fast, what they look for is high-yielding stocks with a consistent history of paying dividends and on financial ratios. Now, that sounds good, but let me back that up and repeat that. What they like to do, they like to track high-yield dividend stocks, which is not a problem in and of itself, but they want dividend consistency. That does not mean the same thing as consecutively increasing their dividend every year. For example, I've made videos on this, but the reason why I don't own SCHD anymore is because they own stocks that have decreased their dividend in just the past couple of years. Like Ford, for example, completely, took their dividend down by like 90-something% in 2020. I don't want to own stocks like that. And also they do things around ROA, which is return on assets, and ROE. And they don't give me the exact ratio where it's, where they let a stock in or not. So for that reason, I'm out. And DGRW is actually the same thing. What they do while this loads, basically they actually look at estimated forecasted earnings, right? they look at estimated forecasted earnings, and a lot of times that's wrong, right? So I don't want to go off of forecast. I want to go off of history. And they also rate stocks based off of ROA and ROE, and they don't give the exact yeah, they're just not very transparent on when a stock is good and when a stock is bad according to those ratios. So for that reason, I'm out. So yeah, I would stick with these, but hey, I mean, they do have great returns, DGRW and SCHD. It's just not for me. I want to hold companies that are constantly and consecutively increasing their dividends every year, and SCHD doesn't do that completely. And DGRW is based off of forecasted earnings and estimated future forecasts, right? So I'm going to be out on both of those. So I hope that helped. This, again, is going to be basically cheaper ETFs with good 5-year returns, good dividend CAGRs, no dividend choppiness. They're all pretty well diversified. And the top 10 holdings are typically within that rule of thumb as well. And I forgot to mention, but a good expense ratio, if you don't like any of these, but you have some others that you have in mind, try and keep that expense ratio under 0.35. Again, it's not like a hard rule, it's just something to keep in mind. Last thing, I wanted to shout out one of our subscribers. Basically, by the way, thank you guys so much. We actually have 15 subscribers now. We're at like 1,300 views, 1,300 views. So that's freaking awesome. And Wolfie X17 said they're going to try out the 30-day cash challenge. So I love that, we're inspiring each other here to be better financially. So that's it for me. Grab the free stocks below if you guys want it. If you guys want to open a brokerage with Robinhood, again, just transparently, I get a kickback from that. But again, thank you guys so much. And I actually am going to post a video that YouTube thinks that you're going to want to watch on the right-hand side here. So thank you so much and talk to you later.